Welcome, everybody, to another edition of Think with a Drink. This week, we are doing 5 questions about investing in a recession. So just real quick for everybody, a couple of the slides have been disorganized because of what we were doing, but just so you know, the Think with a Drink is brought to you by the Ares Foundation for Financial Education. We are a nonprofit dedicated to the mission of trying to help everyone have a better relationship with their money. You can visit our website at www.aresfoundation.org. My name is Tom Alessi. I am the president of the Ares Foundation. I have been in financial services I'm in my 24th year. I'm an investment advisor. That means I act as a fiduciary whenever I'm giving guidance or advice to any of my clients. I want to bring my vice president, Greg. Why don't you introduce yourself?
Sure. So I'm Craig Richardson. I'm the vice president of the Ares Foundation. I've been in financial services a little over 19 years now, and I specialize in working with families and individuals to help them define their financial goals and have a better relationship with their money.
And just so everybody knows that we are recording this, the images that are being recorded are what's shown on the screen, so you don't have to worry about the audience, about your name or camera or anything. We just ask that you keep your microphones muted. There is a chat box, so please use the chat box feature. Some of the questions that we're going to be over actually came from previous sessions that we've done, and so we're just sort of picking up from there. So please feel free to use the chat box. Craig is going to be manning the chat box along as also adding to the presentation as we go along here and also trying to keep us on pace. So real quick, there's a lot of words on the screen. We're not going to read them all. Just know that we're a nonprofit. We do this for education and informational purposes. All we ask is that if you share the videos, whether from our YouTube channel or whether from the website, that you do so in an educational manner. Just know that myself, Craig, the rest of the Ares team, we recommend that anybody who has a question, whether that be of a tax, legal, or financial matter, that you seek out the help of a professional. All right, Craig, on to the fun part for this evening. We call this Think with a Drink. Think with a Drink because we want to make things less intimidating, more casual, more relaxed, more down to earth with all of these financial topics. And so for tonight, because we are doing investing in a recession, we are drinking It Ain't Easy, which I thought tied in nicely to that very well. So It Ain't Easy. This comes to us from Radiant Pig in New York, which actually is now part of the Newport Brewery. And for you and I, we've had a couple of the Newport brews on the show in the past year. So it's an offshoot of that. But this is a double IPA. It comes in at 8% ABV. And, you know, for the folks out there for the food pairing, we like to do a little food pairing thoughts with this. Double IPAs, you know, big hops, big flavor. So like grilled meats, Craig, grilled steak, grilled chops, those type of things. Spicy food, because you'll balance the flavor of the hops and everything. So, you know, like Thai dishes, Mexican dishes. You know, a fun one is, you know, fried foods like French fries. Nice to have, you know, yeah, nice to offset that because the fried food thing with the flavoring will balance that. And then because I know you'd be partial to this, a little off the board thinking a dessert like a rich chocolate cake type of thing.
I love chocolate cake. Now, is this made? It looks orange, so I'm wondering if it was made with Tang because it's a drink of astronauts.
It is not. It is meant to be just an out of this world. Ale is what is why that is. What are you drinking?
I am drinking Be Hoppy by
Oh, there you go. See, another very hoppy thing. So, you know, some of the same things can go along there with Be Hoppy that you would do with this. You know, anytime you get that big, wow, you can get that smell right there. Oh yeah, that's a big burst of citrus and flavor there. Anyway, Skol.
Oh,
What'd you do? Pour it all over yourself?
I opened the can and it all just started coming out.
Either your wife or your kids are trying to mess with you.
Yes. Someone shook the can.
Yeah, that's very. This is not easy drinking. Let's put it that way. This is bold flavors, a lot of hops, a lot of, you know. There's a lot There's a lot going on in this glass right now.
Those are a sipper, not a chugger. Is that what you're saying?
Yeah. Absolutely. Like I said, maybe with French fries though. I'm craving French fries. All right, so let's move on to the topic at hand. I thought the first thing we should do is we should talk about, as we're talking about investing in a recession, this whole thing with the recession.
Okay.
Because the R word is popping its head up again just this week. You've seen the Dow, and most of the markets, the S&P, everything has headed downwards this week because the recession has raised its ugly head, right? As far as going through that. So just understand that we've talked about this. This was a session we had done before, which was the recession is coming. But for you and I, the conversation that we have with folks is that I'm going to try to hide this. There we go. Okay. So that it's, everybody is bantying around whether or not we're actually in a recession or we're going to get to a recession, right?
Right. That's been the question. It's been hedging for the last couple months, right?
The last couple of months. But I mean, for the average person, it pretty much already feels like, because of a recession, what do you get with a recession? You get higher prices,
Right.
you get decreased spending. Like I said, the stock market is down or goes down, which certainly everyone had felt last year.
Right.
The only piece that's missing is a job shrinkage, loss in the job markets.
Right.
That's the only thing. But I mean, on Main Street, it certainly feels like we're already in a recession.
Well, I think it's even in the job market from when I've been talking to different people, you have these big industries that don't have any better clue or handle on it than we have. And they're trying to predict. So they're going, should I be increasing or decreasing? And they're looking at last quarter's earnings and saying, well, I'm not sure which direction we're going in. So it's really weird because I'm seeing it going in both directions. I'm seeing some shrinking or some people losing or changing jobs. What's really interesting is the people I'm seeing who are getting let go from one position or quickly finding another. There's like almost no delay.
Right.
So it's just a really weird market. And like I said, it's kind of, nobody has a crystal ball for this one. Everybody's ball is foggy. So
yes, and that's part of it, right? That's been sort of the overlay, and that's the projection for this year. That was certainly what we said, recently, which is, it's basically, we're calling the highlight for this year foggy at best, right? That's the outlook.
It's like a London weather report, right?
Yes. All right, so let's go to the first question. So, and apologies to the crowd with this and with this, because we had this all set up. We had asked for and gotten questions from different sources, the online and our social media, and the previous webinars and workshops we've done over the past month, and I lost them. But I put them in the screen, but I don't know the people who asked them is what happened. So the first question was, should I be investing during a recession? Right. I believe this came out of one of the workshops that we did previously. This
was Tim or somebody like that who asked this question, if I remember right.
Yeah, something like that. And again, I apologize, for the person who asked it. But anyway, this comes sort of twofold, right? There's sort of two sides to this. If we're talking to somebody who's more than 5 years out from retirement, yeah, I mean, full steam ahead. Keep doing what you're doing, especially if we're talking about as a retirement plan participant, right, Craig? Because this is, keep that I'm buying on the way as we go along here.
Yeah, like I said, I think there's always a little bit of a word of caution when it comes to saying, should I stop investing? Because a lot of times what people will do is they'll actually move out of an investment position because they're afraid of additional losses.
Right.
And what happens in that environment is you start you locking in your losses, right? Because you can't regain. Happened in 2008. A lot of people moved to a cash position. The market started coming back up, but then they were stuck because they were in a cash. And when do you pull the trigger to get back in? Well, you pulled it out exactly when you should have been getting back in at the bottom of the market.
Yeah, you're trying to time the market, and timing the market never works, right? If you're closer, if you're within 5 years of retirement, well, this is a conversation that really should have taken place prior, certainly about the time that COVID hit, about, how you were going to weather through some of this stuff. And certainly by now, like Craig said, you've sort of weathered the major part of this. We might downturn a little bit here, but it's not going to be as dramatic as it has been. We're still trailing a 20% decline here.
Yeah, I think the bigger thing is how do you mitigate risk going forward and you have that short window, but still give yourself the opportunity for some growth. And that's really where you're looking, because what you're trying to do when you're that close is really make sure you have income when you go to retire.
Right.
How do you go to income mode, but in a way that maybe, gets you back on track without, like I said, having more risk. So, and it's different for everybody. So that's something you got to really take a hard look at.
Right. And that's one of those things that really for any, and again, like Craig said, maybe it's, hey, I'm a retirement plan participant. I'm in my 40s or early 50s, but I have other investments that are outside of the retirement plan. That's where those conversations, hey, how do we position this? What do we do with it? How do we make the portfolio, be a little bit more on the defensive side of the wall versus offensive if I'm going to worry about this for the next 12 or 18 months.
But on the other side, if you're, say, 45 or younger, then this is the opportunity you're looking for. These are the opportunities you're looking for. They're buying opportunities, right?
Absolutely.
You're not worried about the short term, you're worried about the long term. So roll in, put what you can in and buy at the bottom of the market. Everything's a fire sale, right? So
buy now, buy more.
Mm-hmm.
All right, so next question. So again, it would be nice if I had the people, but that's okay. It's how do I protect my investments during a recession, right? So, one of the things, and some of this is cliche maybe in terms of talking about, how this works, but there's always that adage of, what is that, Craig? Don't put all your eggs in one basket or something like that.
Pour all your water in one bucket, like you like to use buckets.
Oh, there you go. I like that one. There you go. I like that. So, certainly being, diversified, more allocation strategies, right? That's one of the ways you can do it, because if you're overweighted, and this is the conversation for everybody when we talk about portfolios, and you talk about balance. And it doesn't matter, like Craig said, everybody, different ages, different risks, different what you're trying to do. But the whole idea is you've picked a strategy, whatever that strategy might be. Let's just say for the basis here, because I have alcohol in front of me and it's 5 whatever in the evening. But then I have 4 funds, 25, 25, 25, 25, 25% makes up my whole 100 portfolio. If I didn't touch it for a couple of years, I got overweighted, more than likely in those growth equity positions. And so when the downturn came, I took an extra hit because I hadn't repositioned my allocation strategy because I was overweight. I was happy. Everything was running up. Everything looked good. The numbers were all great. And then, now it's gone because I got overweighted and I didn't realize it. So one of the things you can do is not only diversify the portfolio, but stick with whatever the mix is and keep going back and rebalancing or reallocating the portfolio.
Absolutely. Yeah. And I think, it's nice when you have something that's automated. So it's doing that for you automatically on a regular basis, but that's monthly or quarterly. But if you don't, and not just your 401k, the one that is automatic, sometimes it's your 401k at work.
Right.
But also you're outside, making sure they're rebalanced as well, to match what your overall portfolio should be with all your assets.
Right. So one of the things is, and we talk about this all the time, and we do sort of beat this one over and over and over, but to have an emergency reserve fund. A recession, if the recession does come, that means job. I keep wanting to say constriction, but whatever that is. Because there you go. Job loss. We'll just go that way with it, right? So the possibility that reduction in workforce, reduction in hours, a loss of position could happen. If we don't have money set aside in the bank to carry us through to when we can get the next position, that's where debt happens. And so making sure that there's money in the bank, that there's an emergency reserve, it's a good way to protect myself during the recession.
And I'm going to get you a thesaurus so you have words next time.
That would be very good, and so the other is, be mindful of your debt. If you can speed up or help offset or pay down some of your current debt, again, if the R word does rear its head, we are in a recession. That's going to create a problem. More people are going to get hurt by this because they felt like, well, we got through the pandemic and now I'm okay. And now it might just be that double whammy that, a lot of people just never get out of in terms of that.
Yeah, so the formula is pretty basic. I mean, you want to reduce your overhead and increase your liquidity, right?
That's what it is. That's really what it's all about in terms of, trying to protect yourself. There's nothing sexy about a recession. Let's put it that way. It's definitely something that is, like I said, for most of us feels like it's already here. For the economists and the analysts and the Fed and all of that, until they get their little numbers all lined up and tell us that, hey, we're in a recession now, but for the rest of it already feels like we're there. All right, next question. What are the best investments during a recession? Right. So again, this all depends. This is, it's an individual thing. I believe this came out of one of our in-person workshops, if I remember, because that it's very difficult to try to answer when you're in a group of people and trying to explain that and go through it. But, we always talk about, stocks that have been underpriced or undervalued. Right. So, especially in a downturn, as Craig said, everything is on sale now. But some of those companies that maybe are still doing well, but because everything else is doing crappy, they're getting raked along with everybody else.
Well, the other thing too is to look at what do people stop spending money on in a recession? The fun stuff, right? All the non-fixed expenses.
Correct, right, and that brings us, the second one there is about those things, the opposite.
Right.
What do people need to spend money on? That's what you would look at, right? Essential goods and services, food, healthcare.
Mm-hmm.
That wonderful one from the pandemic, toilet paper, right? All of those products, those are definitely something that's there. They talk about it. It's interesting. I'm this whole, the flight to safety thing, right? Bonds, specifically government bonds, right? Treasuries and those type of things where you can count on it. But the problem is, much like you talked about, Craig, that's almost like selling out of one, moving into another. And then I've got to guess when I got to come out of that.
Well, I guess, but what happens sometimes when the market goes down is you get and the rates go up, and you get this little bit of an inverse thing going on where bond rates and interest rates and savings rates and annuitization rates start going into a more favorable position. So, not necessarily a horrible thing. I mean, you got people getting 4 and 5% interest on accounts again.
Oh yeah, right. So that stuff is picking up, right? So yeah, CDs, money markets, those type of things. Maybe it's not going into government bonds per se. And then the other is real estate, right? Because that becomes the next phase if we are in a prolonged recession. That real estate, suddenly those homes that were bought that were above market now might be below, might be underwater, and then suddenly stuff comes available that might be a better opportunity.
Well, the big ticket items get harder to move, and so cash becomes king. And so some opportunities can really arise in a recession when the market's dragging.
Right, absolutely. All right, moving on. So one of the things we say to everybody and give an opportunity to our audience is, if you ever have questions on any of this stuff, just feel free to reach out to us. You can drop a yes in the chat box. We'll reach out to you. That QR code, you can scan it. It brings up our scheduler. You can book a time to have a conversation with us, whatever is on your mind, whether it is the recession, whether it is your portfolio. We're just trying to figure out what you're doing. We're here. That's what we're, like I said, the goal behind Aries is trying to help everyone have a better relationship with their money. So you can know that you can use that. All right, more questions. This is question number 4, I believe, out of 5, if I'm correct. You keeping track for me?
I believe you're right on track. 4 out of 5.
All right.
About 10 minutes. So
okay. So how does a recession impact the stock market, right? So as we talked about, it's the same thing that occurs for you and I, right? Less money in the market, less money being spent. Now suddenly I've got to, as a company, I've got to start tightening some of the stuff that I do. what's weird that does happen, and this is that conversation, Craig, about why trying to bounce in or bounce out or guess the market or time it doesn't work, because sometimes we can be in a recession and the market will suddenly take off, right? Well, because they don't necessarily correlate to each other. Just because one is down doesn't mean the other is.
Right. And I also think one thing that's been happening in the last few years is we've had a funny thing going on where usually when this market goes down, savings rates and all those things typically go up. However, like I said, since 2018, that hasn't been the case. It's only recently since the Fed started.
It's been since 2012, dude.
Yeah. So, okay, even longer. All right. You remember farther back than I do.
Yeah.
But anyway, so what happened is people weren't pulling out of the market because where were they going to put their money?
Right.
So now what you're seeing is more of a traditional effect. Rates go up, market comes down, and you're seeing people now going into into safer fixed instruments because they're trying to mitigate losses. That's kind of how it's supposed to work, where it's got this inverse relationship. So now you may see, the market not being, I don't think it necessarily was crushed with the recession. I think it was more of a correction of where we actually should be. And hopefully we're going to start getting back on track where a lot more things are based on earnings rather than just speculative.
Well, as we talked about, and I think this one came out of that because we were doing the whole thing about what happens, with a decline, right? So COVID created a decline, and just for the audience, you refer to a decline in the market as anything that's more than 30%, a major downturn, not just a bear market, which is 20, but something that goes beyond that. In the case of COVID back in 2020, the market lost 33, 35% of its, depending on which index you're looking at, of its value. It's a major decline. What happens in every major decline, and I mean, this is going all the way back to the Great Depression, this is looking across different countries and different indexes, that the market goes down, we recover, eventually come back up, and that's usually anywhere from like 18 to 24 months. And then we have what I refer to as an aftershock, another downturn that occurs. And then we go along the bottom for a little while, usually a year or two, and then the market takes off. If you follow the pattern, we're in the bottom now. We're in that we're running along after the second downturn, and it could be anywhere from 12 to 18 months, but the market will run. That's what it does every time. We'll have another bull run of about 5 to 7 years.
Well, I think the other mitigating factor right now, too, is that we haven't had any immigration for the last 3 years. And that means we've had a slump in the workforce itself. Like people are going, well, geez, the unemployment rate is down. How come I go to a restaurant and there's only, 2 waitresses on? Or
yeah, you can't get a table.
You can't get a table, or even, businesses are, you're low capacity for employment. And that's just because the workforce isn't there. So I think you're going to see, it's going to take a couple of years before even the workforce comes back to the level that it should be, especially on all those, basic services. So that will start bolstering the market again as well once the workforce, because bigger workforce means more people spending money. More people spending money means the economy expands. So I think part of this right now, this recession, is not enough people in the workforce.
Yeah, it could be, it's absolutely a part of it, because yes, and then you have the whole great, resignation and all of that stuff going on. All right, last question here. Is there a specific time to be investing during a recession? And I remember this one because it came out of one of our retirement corporate clients. We're doing a workshop and one of the participants had asked us. And, this was one of those, like, specifically, if you are a retirement plan participant, you're in the company 401k or 403b or whatever plan that's being available to you, absolutely you should continue to be investing. And if you haven't signed up, now's a great time to do it, because like Craig said, everything is on sale. So you're buying it at a 20% discount right now. Your other investments, like we talked about, to get back in, this gets a little, depending on, like Craig said, timing, right? It ultimately comes down to how long do you plan to hold this asset? If you're worried about short term, like the next 12 to 18 months, then no, because we're probably going to see somewhat of a downturn come. right? And certainly if we do end up in officially the R word and recession, we will see another drop in the market that will happen.
Mhm.
But from there, it's if you're talking about I'm putting this in and I'm going to hold it for 5 years or 8 years or even 10 years, well then yeah, and now's a great time because everything's 20% down. Even if it loses 10%, another 10%, you're going to come back from that.
And the other thing you brought up earlier, Tom, is liquidity. Do you have savings put aside where you can invest into things that have a longer time horizon, right? That maybe not be as liquid to get a better return. If you don't have that capability because you don't have enough liquidity, then you've got to think about, well, maybe I don't get the big bang for my buck with some of these interest rates right now.
Right. And that is part of it, right? So that whole conversation, because then we're back to I'm trying to time this thing.
Yep.
I'm trying to guess when the time is I should put it in that the market's going to bounce. And guess what? By the time you decide, it's bounced. You've missed it because with all those auto trading and the lightning trades and the robots doing everything, by the time you say and decide to pull the, hey, wait, now might be a good time, you're past it. You missed.
And that's already occurred. I think some of those fixed interest rates that started climbing up have started actually tracking a little bit, ticking the other way now. So we've reached kind of a high with some of those, multi-year rates.
Well, and that's another part of it because the Fed eventually does have to turn the corner. Now they right now they're saying we're pushing full steam ahead. We're going to keep raising rates here, but this is somewhat of what is see now I do need my dictionary, the bluster, right? That's what I was looking. It's more bluster than it is anything else because the Fed can say that and absolutely they can do it, but the Fed has billions of dollars that they are on the hook for to pay a note on that eventually they've negotiated a rate for it, but that deal is going to end. It's like a contract. Like my contract's up, now what I got to do, right? So they're going to want to turn the rate table the other way before those contracts come up because otherwise they're going to be paying the same rate as you and I, and they don't want to do that.
Right.
All right, so those were our questions on all things investing about and dealing with a recession. One of the things we say to everybody, you can, if you check us out, we reinvigorated. Look, I'm just really digging into the dictionary right now. Look at that.
Our college education soon.
Yeah, our blog posts. So we started posting again to begin the year. It's sort of our one of those little promises we made to ourselves, not a resolution that we wanted to do that. But we also post regularly, post every day on whatever social media of choice you have: Facebook, LinkedIn, Instagram, Twitter. One of the things you can do for us, you can like us, you can follow us, you can share our stuff. We're trying to get the word for Aries and the foundation out to everybody. So we just want to make sure, check us out, share a post, like us, do something. We've got our YouTube channel where we record all this stuff and put it on. Certainly, subscribe to the YouTube channel. We're happy to have you and go through that. And like we said, if you have questions, we're here. That's what we do. That's what we want to do. We want to what's on topic for you, what's on point for you, what's most important for you to help you out and try to get that and do it as much as possible. You can go just scan the QR code. It'll bring up our scheduler, and then we will be able to schedule a time with you from there.
I also put the link in the chat box if anybody wants it there too.
You are awesome with that. He's way ahead of me. See that? But we're also available. You can go to the website. It's www.ariesfoundation.org. You can email us, info@ariesfoundation.org, or like I said, shoot that QR code. It'll bring up our calendar, and you can just schedule a time whenever it's convenient to you to go over the questions that are most important to you. Speaking of that, Craig, any questions in the chat box?
We have nothing at this time.
All right, then I am going to say, I barely fought through this thing. This talk at
the same time.
Yeah, it ain't. Yeah, truly and absolutely, it ain't easy. Have a great one.
All right, you too, buddy.